The day manipulation failed. Why banks are panic buying. Silver Monday, December 22nd, 2025, Christmas week. A time when markets are supposed to be quiet, when volatility fades, when nothing dramatic is supposed to happen. And yet, silver did something it had never done before. In a single trading session, silver surged to $69.45 per ounce, gaining nearly 2.5% in one day. No economic data release, no Federal Reserve announcement, no geopolitical shock, just raw, uncontrollable buying pressure. This was not a rally, this was a failure. The failure of a system that had suppressed silver prices for decades. Part 1. Why this move? Was different. Silver has rallied before. It has spiked. It has pulled back. It has frustrated bulls and bears alike. But this move was different for one simple reason. It happened when it wasn't supposed to. Christmas week is typically one of the quietest periods of the year. Liquidity is thin. Senior traders are on vacation. Desks are staffed by junior risk managers whose job is not to take chances, but to avoid them. In this environment, prices usually drift. They do not explode, and yet silver did. That alone should have raised alarms. Part 2. The failed suppression attempt. According to the narrative, the story didn't start on Monday. It started the Friday before. For years, the silver market followed a familiar script. Whenever silver began to rally, large sell orders, massive blocks of paper contracts, would suddenly appear. Prices would be smashed. Momentum would die. Confidence would evaporate. This pattern had worked for decades, until it didn't. On that Friday, banks allegedly attempted the same maneuver: heavy selling, aggressive pressure, an attempt to push silver lower before the weekend. But this time, the market didn't comply. Buyers absorbed the selling, price held, and when the market reopened on Monday, the dam broke. Part 3. The green candle that changed everything. When markets opened on Monday, silver didn't hesitate. It surged. What traders saw on their screens was not a gradual grind higher. It was a violent green candle, the kind that signals distress, not enthusiasm. This was not retail speculation. This was not a news-driven pop. This was forced buying, and forced buying only comes from one place: shorts in trouble. Part 4. The anatomy of a short squeeze. To understand what happened, you need to understand how short positions work. When a bank or hedge fund shorts silver, they are betting the price will fall. If it rises instead, losses mount. At a certain point, risk managers intervene. Positions must be closed, and to close a short, you must buy. That buying pushes the price higher, forcing other shorts into losses, which forces them to buy. This is the feedback loop known as a short squeeze. And once it begins, it feeds on itself. That is exactly what the market witnessed. Part 5. Panic buying, not speculation. One of the most important claims in the transcript is this. This rally was not driven by bullish speculation. It was driven by fear. Banks and hedge funds were not buying because they wanted exposure. They were buying because they had no choice. Losses were accelerating. Margin requirements were rising. Risk models were breaking. In that situation, price becomes irrelevant. Survival becomes the priority. Part 6. Why $70 is the line in the sand. Throughout the move, one number loomed over the market: $70 per ounce. This level is not just psychological. It is technical. It is structural. It is systemic. Silver has never traded sustainably above $70. There is no historical resistance above it. Above $70, silver enters what traders call blue sky territory. No price memory, no reference points, no natural sellers. That is why $70 matters. Because once it breaks, the market enters the unknown. Part 7, the algorithmic trigger. Modern markets are not driven solely by humans. They are driven by algorithms, and algorithms react to levels. Above $70, many trading systems are programmed to buy momentum cover shorts, chase breakouts. A clean break would not just attract human traders, it would unleash machine buying. That is why the battle around $70 is so intense. Part 8. Stop loss cascades. Another accelerant lies just above $70. Stop loss orders. Short sellers protect themselves by placing buy orders above resistance. Once price hits that level, stops trigger automatically. Those buy orders push price higher, which triggers more stops, which pushes price higher still. This cascade effect can turn a breakout into a vertical move in minutes. Part 9. The holiday liquidity trap. Now layer in the timing. Christmas week. Senior traders are gone. Liquidity is thin. Order books are shallow. In this environment, even modest buy orders can cause extreme slippage. When forced buying meets thin liquidity, prices don't climb. They jump. That is exactly what happened. Part 10. Gamma exposure and the options trap. The options market added fuel to the fire. Large volumes of call options were written at the $70 strike. Market makers who sold those calls must hedge their exposure. As price approaches the strike, They are forced to buy silver futures. This is known as gamma hedging. The closer price gets to $70, the more they must buy. In an illiquid market, this becomes explosive. Buying begets buying. Part 11. The physical market is shut down. While all this was happening in paper markets, something else was unfolding quietly. The physical market was offline. Refineries were closed, mints were shut, supply chains were paused for the holidays. No new metal was coming to market, but demand did not stop. Industrial buyers still needed silver, institutions still needed delivery. This sets up a dangerous dynamic. Paper claims increase, and while physical supply is frozen. Part 12. The January supply crunch. This creates a looming problem. When refineries reopen in January, they face a backlog. Demand pulled forward, inventories depleted, delivery expectations rising. This is how short-term squeezes turn into longer-term shortages. Part 13. The media silence. Despite all this, mainstream media said almost nothing. No headlines, no breaking news, no urgent coverage. Why? Because silver is still considered a fringe asset. Ignored, misunderstood, underreported. That silence creates an information gap, and information gaps often precede violent repricing. Part 14. When momentum traders arrive. If silver breaks cleanly above $70, that silence will end. Momentum traders will notice. Trend followers will pile in. Funds that ignore fundamentals will chase charts. That demand doesn't replace existing demand. It adds to it. Part 15. Industrial panic. Buying, there is an even more powerful force waiting. Industrial buyers. When prices rise gradually, manufacturers hedge calmly. When prices spike violently, they panic. They pull future demand into the present. They buy now to avoid higher prices later. That behavior accelerates shortages. Part 16. Why this is price discovery. The transcript frames this moment as the beginning of genuine price discovery. For decades, silver prices were set by paper markets, futures, swaps, unallocated accounts. But paper markets only work when delivery is rare. When delivery is demanded, the illusion breaks. Part 17. Physical versus paper. This is why the advice emphasizes physical silver. Paper instruments promise exposure. Physical metal provides certainty. In a stressed system, that difference matters. Part 18. The warning about leverage. The transcript is clear on one point. Do not use leverage. Volatility cuts both ways. Shakeouts are inevitable. Engineered pullbacks can be violent. Leverage destroys patience. Patience is survival. Part 19. Key levels that matter. Two levels dominate the discussion. $70. Resistance and breakout trigger $67. Critical support. Above $70 confirms a new phase. Below $67 risks a bull trap. Everything revolves around these numbers. Part 20. Why this moment is historic. Every market has a moment when control is lost. 2008 had Lehman, 2020 had treasuries, 2023 had bank runs. Silver's moment may be now, not because of hype, because the mechanisms that suppressed it failed. Part 21. The death spiral feedback loop. Once panic buying begins, it reinforces itself. Short covering drives price. Price drives margin calls. Margin calls force more covering. That is the spiral. And it does not end gently. Part 22. Why timing matters. This did not happen in a normal market environment. It happened at the worst possible time for stability. Late December is when markets lose their shock absorbers. Liquidity dries up, depth disappears, risk tolerance vanishes. Senior traders, the ones with authority to absorb volatility, are gone. What remains are junior desks, automated systems, and rigid risk rules. At the same time, refineries are closed, mints are offline, physical supply is frozen. That means no new metal is coming to market, just as stress is rising. So when buying pressure appears, there's nothing to absorb it. No inventory, no sellers, no flexibility. Timing doesn't just influence markets, it amplifies them. What might have been a manageable move in a normal week becomes explosive when the system is understaffed, undersupplied, and overexposed. This is how small imbalances turn into violent price action. Part 23. What happens? If $70 breaks. The $70 level is not symbolic, it is mechanical. A decisive break above $70 would activate layers of buying simultaneously. First, algorithms. Trend-following systems are designed to buy breakouts. They do not analyze context. They do not question sustainability. They execute. Then, stop-loss orders. Short sellers protect themselves with buy stops above resistance. When those stops trigger, they become market buys, pushing price higher. Next, gamma hedging. Options dealers who sold calls near $70 must hedge by buying futures as price rises. The faster price moves, the more they must buy. Then, momentum traders arrive. Funds that ignore fundamentals but chase price acceleration pile in. Liquidity thins further, slippage increases. Finally, industrial buyers panic. Manufacturers who rely on silver begin pulling future demand into the present. They buy not because price is attractive, but because availability is threatened. When all of this happens at once, markets don't climb, they launch. That is how markets go vertical. Part 24. If it pulls back. None of this means the path is straight. Markets rarely move in clean lines, especially not volatile ones. Pullbacks are possible. Pullbacks are likely. But the character of a pullback in a squeeze is different. In a healthy market, pullbacks relieve pressure. They reset sentiment. They invite new sellers. In a squeeze, pullbacks test conviction. They ask, are shorts truly covered? Is supply actually available? Will buyers reappear at lower prices? If pullbacks are shallow and quickly bought, it signals something important. It means pressure has not been released. It means forced buyers still exist. And it means the move is unfinished. Part 25. The bigger picture. This moment is not just about silver's price, it is about trust. Trust in paper promises. Trust that contracts will settle as expected. Trust that metal exists where it is claimed to exist. For decades, the system worked because that trust was rarely challenged. Few demanded delivery, few questioned availability, few tested the limits. But once trust erodes, markets behave differently. Participants stop assuming, they start verifying. And verification changes everything. When trust fades, price becomes the only clearing mechanism left. Conclusion. The day manipulation failed. December 22nd may be remembered as the day the silver market changed, not because silver made a new high, but because suppression failed. Banks blinked, shorts panicked, and the system showed cracks it could no longer hide. Whether silver explodes immediately or consolidates first is not the core issue. What matters is this. The market revealed stress. And stressed markets do not quietly revert to normal. They move, they strain, they search for resolution, and eventually something gives. The only remaining question is not whether silver reprices. It is how violently the system must adjust when it can no longer pretend everything is under control. Because when forced buyers collide with thin supply, price is no longer a discussion, it is a verdict.